This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. Eric, what do you got?
Katie, today we have the Hoya Capital High Yield REIT ETF with the ticker spelled wrong, but on purpose, RIET. And this is simple. It's going after high-yielding REITs. People are already buying REITs for yield. VNQ, I think, yields about 4%. This would be well over double that. So it's like, what are the highest-yielding REITs? That's what it does. It's not active, though, so it uses an index approach, a multi-factor. It's equal-weighted. 50 basis points is the fee, 87 million. Let's look at what it holds. Now, when you go after high-yielding stocks, you tend to get ones that you haven't heard of or aren't as familiar, and that's what you see here. A lot of these are not that familiar to people. Something like Simon would be normally at the top of a bigger REIT ETF. This is going to get you some different kind of companies here. Let's look at the performance of this versus SPY and versus VNQ, which would be like the biggest one in the category. And you can see it's not been great, right? This is about 4 years. It's down 12%. SPY is up 43%. And VNQ is only down 2%. So this one is sort of like a high beta version of VNQ. That said, what goes down sometimes comes up, Katie. And I think 87 million, by the way, with that performance is pretty good. So when it rallies, it could do even better.
All right, Eric, thank you. And joining us now to talk about this ETF is David Auerbach. He is the CIO of Hoya Capital. David, great to have you with us. Let's start with the performance, because I take a look at a total return basis, and your ETF is just a little bit lower on the year, 3.7% or so, but your benchmark is higher. I understand it's not an actively managed ETF, but how do you explain that divergence?
Yeah, Katie, thanks so much for having me. It's great to be with you guys, and it's a very easy answer. Remember that REITs only represent 2.5% of the S&P 500. That differs to like the technology sector, which is over 30%. Another example, office REITs, which only represent 3% of the REIT industry, generate about 80 to 90% of all the headlines and media coverage that's out there. And so if you really peel back the layers of the onion, we see opportunity in the small and mid-cap REITs. If you buy a VNQ, you're buying the largest market cap weighted names that frankly have like the lowest yields that are out there versus the small and mid-cap names that have both the higher beta, potentially the higher dividend yields, and also, by the way, RIET is the only, that I'm aware of, the only REIT ETF on the market that combines both common and preferred stocks. We have a 10% allocation to liquid REIT preferred stocks. So we use this rules-driven approach to try to provide the most diversified portfolio in terms of market cap, geography, sectors, et cetera, to really put out this almost 10% yield that we pay on a monthly basis annualized.
Okay, REITs themselves, real estate investment trusts, make up about 97%, 98% of the fund. Yet, as Eric pointed out, the ticker on your fund is RIET, and that was not accidental. Can you give us the backstory here?
Yeah, it's very simple. I before E because income comes first. When you buy REITs, I don't think of it from, oh my gosh, this isn't putting up NVIDIA-like numbers. I don't buy REITs for stock price appreciation necessarily. You buy REITs for the dividend income stream. The goal of these management teams, frankly, is to keep the blinders on regardless of what's going on in the world of interest rates. How do we maximize our revenue growth, minimize our expense growth, grow our net income or our bottom line to the highest level that we can, and push out the most that we can to shareholders in the form of dividends. So when you look at the income side of the equation, think about these companies that pay monthly dividends as an example, like a Realty Income or an Agree Realty Trust. If you add up those monthly dividends over the course of a year, 3 years, 5 years, 10 years, et cetera, you're talking a serious income stream that flows through to the bottom line.
David, if you look at the flows into REIT ETFs over the years, they tend to be correlated or inverse correlated to rates, right? Because if you can't get a lot out of like a short-term treasury bill, right now you can get almost 5%. Well, REITs yield a lot, so you're going to go out to find yield. Now you can get that much in really low-risk treasuries. So do you need rates to fall for this category to really blossom, including this ETF, or can you make it even if they hang around 4 or 5%?
It's a great question. We could spend 30 minutes alone on that. REITs somewhat are interest rate sensitive. I've always said 4% is the magic number. If a 10-year Treasury goes below 4%, that's great for REITs, and it really corresponds to the dividend yield. If you market cap weight the dividend yields across the sector, it's about 4%. If you equal cap weight those yields, it really goes to like 6.5% or so. And so really on a risk-adjusted basis, that's why we see this value again in the small and mid-cap names. But right now, with REITs trading around the 4.5% level, REITs are the punching bag that's out there. And I think it leads to that 45% underperformance versus the S&P. If you look at the Bank of America Advisor survey recently, REITs are basically the most unloved sector that's out there. And should the Fed cut rates, you want to be ahead of that curve. You don't want to do that trade after the Fed cuts rates. And again, with them only being a 2.5% exposure in the S&P, it really is almost like I don't want to say it's a no-brainer, but there really is no cost in being wrong because it's such a de minimis part of that index.
Well, I want to talk about that a little bit more, that in your view, this is the most underloved sector. I hear what you're saying, that you want to be ahead of the curve. You want to get in before the Fed cuts interest rates. But when it comes to socializing this area to the broader investment public, is that what it's going to take in your view? Is it going to take the Fed actually finally lowering interest rates in a meaningful way?
Well, it's funny because I kind of sit there every single day and say, look, we use REIT-owned properties every single day, not thinking about what's going on with the world of the Fed or the 10-year Treasury. As an example, we're utilizing a data center REIT to facilitate this conversation today. You order an Amazon package, you use 3 different REIT sectors to get that package to your doorstep. We use REIT-owned properties every single day of our lives. Obviously, from the headlines perspective, from the business network's perspective, to the advisors and the investors, if the Fed does cut rates, then it should bode well for REITs. But for these management teams, they've been operating in this environment, this high for long environment, for several years now. Mm-hmm. The debt markets are wide open. Those REITs that are well capitalized have raised tens of billions of dollars of new debt in the past few months. Right. And so it's business as usual for a lot of these guys. Frankly, REITs are the most tariff resistant of a lot of all those sectors that are out there, since the majority of those revenues that are earned are all domestic based. Right. And so really, we think this is an opportunity.
All right, David, got to leave it there. Great to get some time with you. That is David Auerbach of Hoya Capital. And you can read about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. But that does it for Bloomberg ETF IQ, the TV show.